please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Head across to the Axis Capital Conference, so that's underway in London currently. Kashyap Pujara joins in from the sidelines. Hi Kashyap, thanks very much for joining in. Let's first in fact start off with macros, because that's how the markets are reacting now to the challenging macros, rising crude, weakening rupee. What's your call on the outlook for the entire macro set of indicators, and how do you think the market will react from here on?
See, macro is clearly a challenge. It's a headwind which has been there. The rupee going to 71 and beyond is definitely a challenge, and a bit higher than what one were accustomed to. Having said that, one needs to keep in mind that we are in an inflation targeting regime, and it will be over to RBI to, how they basically, rein in the inflation expectations, which would eventually, over time, make the rupee come back to its fair level. So even though, it's gone beyond the threshold in the interim, we are of the view that, things will improve and rupee would broadly settle down in the 70s kind of range, and not, depreciate further from here on. In a sense, our expectation is that, the commentary could be a bit hawkish, and it is likely that we might see, a couple of rate hikes through the year.
Okay, so if your take is that the rupee is going to stabilize around these 70-odd levels and not depreciate further, in that case, do you think most of the rally in export sectors like IT and pharma has played out, or do you think there's still some more steam left in these stocks?
Structurally, rupee depreciation is a tailwind for them, but one will have to see, which businesses, when it comes to exports, have sustainable demand drivers and not just a tailwind of rupee depreciation. See, rupee depreciation per se, purely from a perspective of the inflation differential between, say, a USD versus the Indian context, would in a way depreciate 2-3% per annum purely on the basis of the inflation differential that we would be at. But that apart, one should actually see the structural drivers of demand and from the export side, and see how the competitiveness is, and then take the call rather than purely a INR depreciation call. On the IT side, we clearly see, the first quarter going on the right note, at least beginning on the right note. We do see the top tier companies, which will be able to demonstrate 6 to 8% constant currency kind of growth. We are seeing deal sizes getting larger, and the tailwind of rupee depreciation will enable them to reinvest some of that into building further capabilities. So we do see IT to be in a good pocket even now. Pharma, we are more, domestic pharma driven. We feel that, it's very difficult to forecast how things are going to be when it comes to exports to US. But the domestic pharma side is more like a consumption kind of a play. Valuations are reasonable, and we can see demand sustaining for quite a long time. So our preference is towards more domestic focused names in the pharma space.
Kashyap, on consumers, I know that you're positive about and confident of the earnings growth there, but more and more noise one is hearing about valuations. They've always been high, but at some point it starts to matter, and I guess that's now. Stocks are down between 8-10% from their recent highs. At the conference, are you hearing that sort of worry about valuations being far too high?
We feel that, large part of this earnings growth is already priced in most of these stocks, because if you look at staples, it's no longer about absolute investing. It is only about relative investing as to who is cheaper versus the other, but it's not about absolute investing altogether. In fact, the IRRs that one can expect on these stocks at the current point in time are close to single digits, which means that markets are actually looking at a very low discount rate that there is no cost of equity or very low cost of equity for these stocks. And many of these names, even if you were to take a call that in 4 years or 5 years that top line doubles with expansion of margins, even 4-5 years out, they are still looking like 25 times or thereabouts. So valuation is clearly a miss, and that's why we feel that one will actually have to be a bit more picky and and maybe look at companies a bit more differently rather than looking at the same favorites.
Fair enough. Kashyap, any other space, that you think is going to outperform you know, any other space, any other theme really that you find attractive from an absolute investing perspective? Because as you said, many are now just relative investing plays.
If you broadly look at the recommendations which were made in the report, they were largely based on underpenetrated stories. So when you are mentioning the India Energy Exchange, again, that is clearly, you know, the power trade that, you know, traded through the exchange is extremely low from a penetration standpoint. And that's been seeing growth. If you look at business services, we are quite optimistic on business services, be it the staffing business or the facility management or the security services. Again, those spaces are really fragmented, unconsolidated, where few leaders are, you know, in a position to consolidate the market and continue to grow at a high point. So we are very optimistic on that one. When you look at Pharma, the name you just mentioned, essentially it's a company with high return on capital, no debt, growing consistently at a high point. So we feel that, you know, the domestic names are more, domestic pharma stories are more like a proxy to staples in a sense, because they are consumable, consumption-based stories, but in the pharma context. And we feel that the valuation is comparatively substantially cheaper to what you are paying up for a staple. And the growth profile of these companies are better than what you actually get from staples. Whereas the return on capital employed is reasonably strong. The profile is free cash flow. So essentially we feel that these are the stories which we would be placing our bets on.
Kashyap, thanks very much. Have a good conference. Appreciate you joining us here